What if I told you that building long-term wealth doesn't actually require you to spend hours analyzing financial reports or, trying to predict the next big winning stock? What if the secret to real growth was actually rooted in utter simplicity? It really is the ultimate question, isn't it? What if you literally just didn't need to pick stocks to build wealth? Well, it turns out this straightforward concept is highly praised by one of the greatest investors of all time, Warren Buffett. He believes most people absolutely do not need to pick individual stocks to grow their money. Instead, there's a remarkably simple strategy where you just invest consistently and then you let time do all the heavy lifting. You don't have to predict a thing. So in this explainer, we're going to cover exactly what index funds are, the Warren Buffett approach, the absolute power of compounding, how index funds stack up against individual stocks, and finally, those common beginner mistakes you need to avoid. All right, let's jump right into section 1. What are index funds? The basics of broad investing. Okay, so think of an index fund like this. Instead of trying to find the needle in the haystack, you just buy the whole haystack. It's a type of investment fund designed to follow a specific market index. So rather than betting all your hard-earned cash on one single business, you're buying a tiny piece of many successful businesses all at once. Boom, instant diversification. Your money is spread across the broader market instead of relying on the success of just one CEO or one product. To put that into perspective, just think of the number 500. An S&P 500 index fund tracks the performance of roughly 500 of the largest US companies. You aren't gambling your savings on some trendy tech startup, you're getting a tiny slice of 500 massive businesses simultaneously, which basically spreads your risk across the entire board. And the mechanism behind this is just brilliant in its simplicity. Step 1, your money is pooled together with thousands or even millions of other investors. Step 2, the fund uses that massive collective pool to buy shares of the companies in the index. And step 3, as those companies grow and increase in value, your portfolio grows right alongside them. You aren't losing sleep trying to beat the market, you're just effortlessly matching it over time. Which brings us to section 2, the Warren Buffett approach, and why the pros keep it simple. Now, Buffett is legendary for picking winning companies, right? Which makes this quote so fascinating. For many investors, low-cost index funds can be a smart choice. He openly admits that consistently beating the market is incredibly difficult. I mean, even for Wall Street pros with massive teams and endless resources, it is tough. Index funds just remove all that immense pressure of finding the perfect stock and replace it with patience, consistency, and highly predictable long-term growth. And honestly, the real secret weapon here? Low fees. Active management means you've got professionals constantly buying and selling, trying to outsmart the market, which racks up massive fees. Index funds, on the other hand, use a simple, automated strategy to just match the market. That keeps your expenses incredibly low. Over decades, those tiny differences in fees mean you're keeping significantly more of your own wealth, rather than handing it over to money managers. Moving on to section 3, and my favorite part, the power of compounding, where time is your greatest asset. Just watch how this unfolds over time. Let's say you start investing consistently in year 1. By year 10, something pretty amazing happens. Your returns start generating their own returns. Fast forward to year 20, and that compound growth really starts to accelerate. By year 30, you've built significant wealth. Your money makes money, and then that new money makes even more money. Starting early is so much more important than trying to predict every little market swing. But here is a harsh truth. The absolute biggest mistake beginners make is waiting. Waiting for the perfect moment, or waiting until they magically earn more money. Or, waiting until they fully understand every little thing about finance. Actually, scratch that. The only thing you really need to understand is that you have to stop waiting. Consistency and time in the market will always, always beat trying to time the market. Let's tackle the big debate in section 4, index funds versus stocks, weighing the risk and reward. So, while picking a winning individual stock might offer higher potential returns if you somehow pick perfectly, the risk is massive. A single bad CEO, a corporate scandal, or a failed product launch can literally decimate your investment overnight. Index funds completely change the game by spreading that risk out across hundreds of companies. It's a much safer, lower-risk way to capture the market's overall growth without betting your entire financial future on just one single business. Finally, let's wrap up with section 5, common beginner mistakes and avoiding those emotional traps. Because let's face it, human psychology is often our own worst enemy when investing. It usually comes down to 3 classic traps. Number 1, invest in emotionally and panic selling when the markets inevitably fall. Number 2, checking your investments every single day. Seriously, just don't do it. And 3, expecting to build overnight wealth. Long-term investing really requires leaving your emotions completely at the door. Building wealth is a marathon, not a sprint. Index funds are definitely not a get-rich-quick scheme. They are a highly effective discipline. Small, consistent decisions repeated over years and decades are what truly pave the way to financial freedom. Consistency and discipline are for sure the real heroes of this story. So, I'll leave you with this thought. The formula is no secret. Keep your fees low, invest consistently, and give it decades. Are you going to keep trying to outsmart the market, or will you step back, let time do the heavy lifting, and start your marathon today?